Good morning, Instagram. Good morning, YouTube. Here we are again. Mortgage rates watched today. All right. So we're gonna talk about an interesting subject today. Um, it's gonna be hopefully it's gonna be a short one. Monday, I sent a basically on the segment of your market today. Actually, I think after the segment of mortgage rates watch today, I I basically sent an Instagram, mm, talking about the excitement of what's going on um, in the mortgage rates part of the industry, or in the mortgage industry. Um, I'm talking for everyone, but if you're a realtor, I was explaining in the Spanish section that we are a industry divided into two. I would call it two sub industry: mortgage and real estate. So one cannot survive without the other. Um, so and basically, because of that, whatever is happening on our side, it affects positively or negatively the other side. But mostly, it goes in this direction. Whatever happens in real estate is dependent on what happens on the mortgage side. So basically, real estate depends a lot on what happens with us. And it is a proven fact. We have seen it happen in the last 24 months because of rate hikes conducted by the Feds to basically um, bring down inflation. We've seen what has basically happened, and it is that real estate has become stagnant. Nothing has been moving lately. Um, Basically, we lost 50% of the market, kind of sales in real estate. And with it, we lost about 50% of tells you that we are an industry that basically is commingle. It's basically one goes hand in hand with the other. So um, because of that, we are excited on the mortgage side. We are really excited for what we are seeing since Monday. Actually, not since Monday, since the last 2 weeks or 2 weeks and a half, we have seen a tendency on mortgage rate going downward. So, which it is really exciting. Now, it hasn't reflected yet 100% um, in the final price, I would say, or 100% to the consumer, because some way somehow lenders and banks, they need to make sure they're liquid enough, and that's my opinion, they're liquid enough before they can just say, hey, we're in a new market, we rates are down, now let's go, let's start producing applications and this and that. So but one thing we saw on Monday was the the 10-year Treasury um, crossed the benchmark of 100. That's a lot. That means a lot. So it is something that has been waited for a long time now, and finally this Monday did happen. So right now as we stand, right now is fluctuating between 99.7 um, and 100. So it hasn't hit 100 today, but we're certain that it might hit 100 again today. So the way it works is it's going to stay in the 199.5 to 100 for a while until the industry is certain that it's time to move on. Basically, because of the data that's coming, inflation is down, consumer sentiment is high, spending is high. So there's so much happening that is pointing to a more robust and stronger economy. Because of that, investors are feeling comfortable, and bonds and MBS are reacting. So basically, that benchmark of 100 for 10-year treasuries is telling us, it's telling us a lot. So basically, what it tells is the story that's telling is that if we keep going in that direction, and at some point the new benchmark becomes 100, and then from there on, okay, interest rates are going to drop. So if this week by Friday we are at 100.5 or 100.75 or even 100.1, then right there we know that we are trending to go to the magic number, which it is 100.300. So when that happens, basically what's going to happen is interest rates are going to start basically going in the direction that everyone is waiting for. Now, is it good to wait for a low interest rate if we're talking to buyers? Because that's what we do. We do mortgages, and we do mortgage loans, and mortgage loans are only good to buy properties. So this is my personal opinion. Okay, personal opinion doesn't have to be. You don't have to take it 100%. I advise you to always look for more advice, either from a financial advisor, a lawyer. Okay, but with regards to mortgages, okay, or real estate agents, but with regards to mortgages, this is how we look at it. So mortgages, what they do is they affect pricing on real estate. Okay, mortgage rates affect pricing on real estate. So what that means is when mortgage rates go up, real estate prices go down, unless it is a situation like the one we've been living through, which it is a low inventory situation. That's different. Okay, and that's why more home prices haven't dropped, because there's no inventory, and if there's no inventory, basically there's no way to go. Even though interest rates are high, mortgage rates are high, okay, home prices have basically stayed the same, or in many markets still go up. So that's something for you to keep in mind. So what happens when rates start to go down? What is going to happen? And that's something I want you to share with your clients, your families. We want to share it with yourself if you are a consumer. Okay, when rates starts to go down, home prices will start to go up, unless okay, inventory production ramp up. If it ramps up, then is a different story. But by the data we have, inventory, inventory against demand is not going to catch up until at least 2025. And that's not a good news, because what that means is it doesn't matter if rates go down. The only thing that's going to happen is if rates go down, inventory prices are going to go up. And this is why my personal opinion, talk to your real estate agent about it. Okay. If you are waiting for rates to go down to be able to jump and buy, you might find yourself in a very difficult predicament. and that is that you are going to go against competitors trying to buy your property. Yes, rates are going to go down, but then now, what possibility is going to be that you will buy if all of a sudden sellers begin to be more strict, or more they have more requirements with regards to who's going to buy their property, because now they want a strong offer. Now they might want to get more money for their property, even more money than appraised value. Because remember, this is a free market. You can sell your property for whatever you want. So a seller might say, well, I have 10 offers. Is a market of supply and demand. You know, I have my property. There is 10, 20 people who wants it. And it becomes an auction. So who gives more? And that person, that seller, in a free market like we are, basically has a right to choose whoever wants to pay more for their property. So rates go down. Oh, yes, rates are down to 5.5. Now we have a surge of buyers coming into the market. And now that same property you want to buy that's going for 450. Now you have somebody coming and saying, I want that property. I'm not going to be left out like last time. I'm going to offer 475. And it is the right of the seller to take that extra 25,000. Even if appraisal comes in at 450, they're not jacking up price. It's about supply and demand. It's not fair, but it is what it is. It's a free market. So that's why my personal opinion is you have to look really well, think it twice. Right now, the rates are high, and maybe talk to your real estate agent. Talk to us about, getting into a mortgage and taking the risk if you feel like, if after doing your research, you feel like you need to take the risk, you know, hey, we're here to help. Okay, we're here to help. That's our job. So this is basically what I had mostly. I wanted to bring up today. It is about the point that you have to watch, and this is something I can advise you. You don't have to. You don't have to wait for me to tell you what's going on. My advice to you: there is a bench, there is an index you can follow, and that will tell you and me what's going on. There's a lot of other factors, data coming in, and reports from the feds and different institutions from the government that oversee basically the state of the economy. But my advice to you is there's an index that can tell you where we're heading to. It is called the 10-year US Treasury. So go into Google or Yahoo, whatever you want to go to, and search 10-year US Treasury. Follow it every day. Google it. If you see that the trend is that it's going up, okay, that means rates are going to go down. If you see that's going down, the trend is going down, rates are going to go up. So what that tells you is, and that gives you is a map to follow to know when to get in. And don't wait for the spike of buyers. Getting at the right time, buy, and basically you're going to escape from having to refinance later. Okay, that's a fact. We all we all have to buy a property at some point. Okay, and we all will be refinancing at some point too. But buying at the rates we have right now will require a refinancing later. And we're not advising you to get into a mortgage because we want you to refinance later. We just want you to be informed that the way the market works is as rates go up, real estate prices come down. It hasn't happened in the last, what, 12 months, 24 months or more because inventory levels are too low. Now, one thing for sure we know, and you can Google it and find out information, this is public information, is that inventory levels are not going to catch up with demand until late 2025. So, if you add all that up, if you add it and you go, inventory levels are low, mortgage rates are high, but they're coming down. So, if demand increases because of mortgage rates going down, so there's only one way for home prices to go, and it is up because of inventory being so low. Now, now, do you want to wait for home prices to go down? I mean, to go up higher? Okay. Or do you want to get in now, possibly buy at the prices they have right now, and rates when rates go down, then you refinance your property and you come down to maybe the price or the monthly payment you want to be. Of course, my advice to you: do never ever get into a mortgage you cannot afford. Okay, and that's something we will not do because there is no way you can do that right now. There's no way because the way it is right now, okay, the way it is right now, the ability to repay, okay, it is enforced 100%, and no lender is going to give you a loan you cannot afford. Now let's talk about affordability because we can confuse that, okay, and irresponsible spending. So what is affordability? You make $7,000, and out of that $7,000, okay, you are supposed to use 45% of that money to buy and pay your home expenses. Now, if you come to me and you tell me I cannot afford it because you have it in reversed, you have 60% of spending on things that are not critical. This is something very important. Things are not food, shelter, medicine, okay? Luxury, luxury cars, luxury handbag, luxury watches, and your money is going to that route instead of going into where it needs to go. That's not on affordability. That means irresponsible spending. And we have all been guilty in a consumer um, market, in a society where we're being pushed to consume and consume and consume. We are all guilty of it. But there is a difference between affordability and not putting the money in the right place, not putting your money in the right place, and having a habit of irresponsible spending. So that's something I maybe wanted to clarify because, yes, I've seen it where people make $10,000 and they cannot afford to buy a property because those $10,000 are going into things that are not critical. And right there, the ability to repay, okay, if you have too much debts going to places that are not supposed to be, of course you're not going to qualify. But if you have and you can cut on unnecessary expenses and we can prove it to you, then it's your responsibility to go back, cut on those expenses, and then put your money where it needs to be, in shelter, in a good shelter for you and your family, in a good property. So that's one thing, one opinion that I have, and maybe you can take. So basically, I mean, follow the 10-year treasury, see what's going, see when you need to make a move because you don't want to be checkmate, okay, by your opponent, which it is the market. So from us at HDH Mortgage, this is what we have for you today in Mortgage Rates Watched Today. We hope to see you on Friday. If you want more specific information related to mortgage rates and things like that, call us to 1-800-477-2251, 407-214-9400, and we can answer all of your questions, help you with your mortgage process. Um, and basically, we are in downtown Orlando, Florida. We cover the whole state of Florida. And our NMLS, if you want to find out more about us, is 172-1096, 172-1096. That's our NMLS number. And you can find us in consumeraccess.org online. So you can find us online too, www.hdhmortgage.com. So it was a pleasure to be here with you today. Looking forward to seeing you on Friday with our segment of Mortgage Rates Watch Today in English, and at 10 a.m. On Friday, actually, at 12:30, it's going to be Tu Mercado Hoy in Spanish. So let's close our Instagram and looking forward to seeing you on Friday. YouTube, bye bye. See you later. And we'll see you on Friday here at Mortgage Rates Watch Today. So thank you for being with us today. And we'll see you next time. Bye bye.